Let's look at the VIX, Wall Street's fear index. It is down. That indicates nothing too worrisome on the short-term horizon, lower by about 4.5%. But with the S&P clocking its worst first half of the year since 1970, yes, folks, the Nixon era. Let's turn to our floor show traders and get their interpretation. Scott Fullman and Dutch Masters. Dutch, I know you. You remember 1970, MASH, love story, ugly first half for the markets. What's your anxiety level today versus back then?
I remember my parents making me sit in the car in the line for the gasoline to get at the gas station.
Yeah, I remember that too.
My anxiety level is that we've come to terms with the fact that I think we're going to run into a higher inflationary environment over the next 3 to 5 years, and we're definitely in a stagflation situation. So we have geared up to trade in a range rather than look for a booming bull.
Okay, and I find it interesting that you like this company, Mullen Automotive, at a time when we are looking at extraordinarily high gasoline prices. Who knows, maybe they will come down with a holiday on the gas tax, but that doesn't appear to be where Congress is going to move. Why that particular stock?
Well, we saw that the electric vehicle market was beginning to percolate a little bit. They have an EV, and they also have EV technology that was just announced that that their battery seems to have the longest range right now. We know that over time, whoever has the best battery is going to be an argument that's, passes from one hand to the other over time. But right now, theirs does look extremely promising. We love, the fact that they and, a company like Workhorse have come down, 80, 90% from their highs. And anytime you have a company that comes down 90% and isn't going to go bankrupt, you can sometimes get a heck of a trade off the bottom.
Well, that is true. And that brings me to Scott. Yesterday, Carvana and Chewy, both who have been hammered over the past year, were the leaders in many cases. I mean, those were big, strong names. What do you like now after hearing what Jay Powell said?
So we're focusing on a couple of things. First of all, we're looking at the stock LI, which is also, that's an auto stock, a Chinese EV auto stock. It's doing fairly well. It picked up a lot of momentum after breaking out of a base. And again, people are looking for alternatives at this point. We think that that is definitely a place to be looking. Also, we're looking at Dio New Energy, it's DQ, also breaking out of a really nice base here. And taking off. It's outperforming in the semiconductor space. I mean, even though it's got new energy in its title, it's a semiconductor company, and it seems to be leading that group right now, Liz.
Yeah.
And I have to tell you, it's really nice to see us getting some, decent moves in the market for a change. Bringing back a little bit of investor confidence, but we caution that the market is extremely sensitive to news right now. And when it's sensitive to news, that's when people should still be very, very careful.
And Dutch, I know you are always hedging because you are cautious. What's your hedging play?
So we're still in the SPXU inverse ETF that that we like to use.
Yeah.
So I'd say we're about 60% short right now, and we're about 30% long and 10% in cash.
Yep. SPXU, of course, is the ultra pro short of the S&P. Good to see you both, gentlemen. Thank you so much.